Good afternoon, ladies and gentlemen, and welcome to the One Heritage Group PLC annual results investor presentation. Throughout this presentation, investors will be in listen-only mode. Questions are encouraged, can be submitted at any time using the Q&A tab situated on the right-hand corner of your screen. Please just simply type in your question and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it's appropriate to do so. We'll notify you by email when they're ready for your review. I'd also like to remind you that this presentation is being recorded. Before we begin, we would like to submit the following poll, and if you would give that your kind attention, I'm sure the company will be most grateful. And I'd now like to hand over to Luke Piggin, Group FT, and Jason Upton, CEO from One Heritage. Good afternoon.
Good afternoon, and thank you for attending and welcome to our maiden annual results presentation for the year to 30th of June 2021. I'm Jason Upton, CEO of One Heritage Group. I'm joined by Luke Piggin, our Finance Director, to run through today's presentation. And we'll just start by turning our cameras off whilst we run through the presentation, and we'll turn them back on for any questions after. So to give a brief introduction of One Heritage Group to those that don't know us, and a reminder to those that do, we are a residential property development and management company, and we focus on developing high quality self-contained apartments, both refurbishments and new build projects, along with the development of co-living accommodation, primarily across the north of England. Our services also expand further than just a developer, with the provision of property services within the group, along with acting as development manager for third-party owned developments. And at the start of the year, we set 5 strategic priorities for the group, and I'm pleased with the progress we've made against these, despite the backdrop of COVID. Firstly, our main priority has been focused on successfully delivering our development projects, which I will update further on later, with 3 due to complete from Q1 next year. It is these developments we've also focused on securing sales for, which, despite the restrictions over the last year, with reservations for close to 50% of our properties currently under construction, and steps have been taken to expand our sales network further. Our third priority, property services, has faced challenges, which were originally through a group of associated companies, but the poor management of this externally run entity led to the liquidation of 2 of the 5 operating businesses, and as a result, taking it as an opportunity to bring in-house and have recruited appropriate personnel. I'm expecting to see further changes and enhancements to our property service provisions over the coming months as we plan for our developments post-completion. And our recruitment continues to be focused on bringing in the right talent that complements the strong working culture we have within the business. We've made some excellent hires over the last 12 months, including a property operations director, a number of graduates and experienced chartered surveyors to expand our development team. And our culture and the talent we bring into the business, I believe, is fundamental to our success, and recruitment and the development of talent will continue to be a fundamental priority for the business over the next period for us. And finally, our 5th strategic priority has been to grow the pipeline of new development opportunities. We've added 2 developments since our listing in December 2020, along with a new project under development management agreement, which has complemented the existing projects we have within the group, and this will continue to be a priority as we look to plan after our existing developments complete. So our strategy covers 3 core elements. Firstly, we are a residential property developer. We acquire development sites within the group, both new build projects or the redevelopment of existing buildings, such as offices, which we convert into self-contained apartments. The north of England is our preferred location, areas of growth and with high demand from young working professionals, along with good transport links. And we target development projects that contain up to 100 units, which benefit from shorter construction timeframes, such as 12 to 18 months, to maximise the return on capital deployed and reduce the risk associated with longer construction timeframes, particularly important when we have so much uncertainty at the moment around input costs. And we have 5 development sites owned by the group with a gross development value of 26.3 million, with 3 under construction and 2 due to start construction shortly. And profits will be generated once completed and sold, which we expect to be from Q1 next year. Secondly, we act as development manager for schemes owned by a third party, whereby the group receives a management fee for our services, along with a profit share of the completed and sold projects. And currently we have 3 projects under a development management agreement generating income for the group. And finally, the third element being property services and co-living. We undertake various property services such as lettings, and the group also receives a profit from sold co-living properties. And these services were previously provided by an associate group of companies who are independently managed, where we got a share of the profits. But due to the liquidation of 2 of these companies, we've taken the opportunity to bring property services in-house sooner, which I'll elaborate further on later. And these 3 core strategies, we believe, provide a good balance: development profits as developer, supported by fees generated from development management projects and our property services activities, which generate a recurring source of income that's especially beneficial considering the equity tied up in developments until 2022 at the earliest. And what we believe gives us a competitive advantage against other developers is our wider network in Hong Kong and Asia, which we are demonstrating by securing reservations for nearly 50 of our properties under construction. And this network's mainly through our majority shareholder, One Heritage Property Development, who are based in Hong Kong and provide the UK group with key sales and marketing function, providing the ability to maximise returns quicker by selling overseas. And having a presence and infrastructure in the Far East we can access, who understand the cultural differences to effectively market and sell our property, brings significant benefits to us as we look to take the risk out of selling our developments at the earliest opportunity. And this infrastructure and network has facilitated over £11 million of reservations for the group, as we expect the vast majority, if not all, of our property to be sold prior to practical completion. And this enables us to realise profit and redeploy capital sooner, rather than continue to market developments once the development is finished. So to provide an overview of the 5 developments we have within the group, we have 3 currently under construction and expect to complete in the first quarter of next year. 2 developments have unfortunately been impacted by planning delays, which has been an ongoing challenge given the level of delays and the lack of communication from the start of the pandemic in particular. Both Churchgate in Leicester and St Peter's Gate in Stockport we submitted planning applications for in March this year. Both today have been validated but not yet determined, which we're confident of shortly. Our St Peter's Gate development does have the benefit of permitted development rights, but we submitted planning to make sure the scheme was more efficient and profitable, which includes an extension to the roof, increasing the number of apartments from 15 to 18. In Churchgate, it's been a challenge. The site's in a conservation area and backs onto a church. The sensitivities with this development and recent delays with the planning process has been frustrating, but unfortunately out of our control with recent delays due to the planning application process rather than issues with the development itself. And of the 3 under construction, all have fixed price build contracts in place, which has limited our exposure to material price increases in the industry over the course of this year. The advantage of these contracts is it removes price uncertainty from projects, but the knock-on impact is that it's pushed onto the contractors, which we will be monitoring closely. Overall, positive construction progress today, which I'll update further on shortly. So to provide an update on sales, we are pleased with the progress made and pre-sales for our developments are going well. We signed an agency agreement which underwrites the full purchase of Oscar House earlier this year, and our Bank Street development is already 60% reserved. Lincoln House recently has been relaunched and the sales this week have increased from 22 to 29 out of 88. So we're hopeful that momentum will now be generated with this scheme. We still have over 3 months of marketing our developments and demand continues to be strong. St Peter's Gate, although we haven't formally started to market it, we have had 10 reservations recently, which is over 50% of the development prior to formal works commencing on site. And these are reservations for apartments that are covered by permitted development rights, which will not be affected by any planning amendments. And it's this level of interest at such an early stage which is creating some excitement considering the level of this demand already. Formal exchanges of these units usually happen within 28 days of a reservation and completion once the development is complete. We're expecting to provide a further update on reservations and pre-sales over the coming weeks. With the business being supported by a wider group and its sales and marketing network across Hong Kong and Asia, we're well placed in accessing these markets. And this, we believe, provides a significant benefit to us, which is evident from the level of pre-sales of our developments, of which aren't due to finish until next year. And to provide a more detailed update on construction activity, Bank Street, the former courthouse in Sheffield, is a conversion into 23 self-contained apartments due to complete in Q1 2022. The majority of the site enabling works have been completed on the building, with extensive alterations made to the building structure, including the installation of new structural wall to the rear of the property. Works to erect the second story extension have commenced, with the building due to be wind and watertight by November. And internal fit-out works have commenced, including partition, first fix mechanical and electrical, and tanking to the lower ground floor. The construction of the mezzanine floors are well progressed, and the majority of the external works, including roof repairs, have been completed. We're particularly excited by the design of this scheme, with duplex-style apartments and with some of the building character retained. This and the central location of the building has had a positive influence on sales, and we do expect most, if not all, of the remaining unsold apartments to be sold by the end of the year. At Lincoln House, an 88 apartment conversion of a former office, we have appointed Medlock Construction as principal contractor, and works are progressing well on programme. All enabling works are completed, internal fit out is well progressed, with partitions over 50% completed, and plastering works commenced. First fix mechanical and electrical works are progressing well and closely follow the partition installation. Externally, the steel framing system's been completed, and external facades now being made wind and watertight, with the installation of the cement fiberboard and windows. And installation and rendering are due to commence in the coming weeks, with works due for completion Q1 2022. With upgrades to external facade have enabled us to go beyond the requirements under the building regulations in relation to fire safety on this development. Our Oscar House project is located on Chester Road in Manchester and is a new build development providing 27 self-contained apartments due to complete again in Q1 2022. All groundworks have been completed, the steel frame has been erected, and the rib deck and concrete floors have been poured. Externally, the steel framing system has been installed to the ground floor, with the external masonry cladding being laid. Roofing works are due to commence in the coming weeks, along with internal fit-out, with partitions due to commence shortly. And following a review of the external facade design, we made the decision to replace all external materials with certified non-flammable products, including insulation, breather membrane, and aluminium cladding, meaning an EWS1 can be provided to buyers. And these enhancements to improve fire safety to provide EWS1 is something we are doing on all developments, despite it not being a statutory requirement, which future-proofs against regulation changes. The only exception to this is Bank Street, which is an existing concrete building. We have 3 active development management agreements, which generate a combination of development management fees over the period of the development and a profit share on completion. We announced recently a new agreement for Queen Street, which is a template of agreements we expect going forwards. Here we take a 1% fee on any capital that's raised for the development, a development management fee of 2% of development cost, and a 15% profit share on completion. These agreements are positive for business. They offer a different income stream, whilst also allowing the group to scale more efficiently. And of the 3 development management agreements, former Oldham County Court is the most advanced. We signed a forward funding agreement with Baltimore Home, a registered housing association, to acquire the completed development of 42 residential apartments, providing affordable housing. Works have commenced on site, with strip out and enabling works being undertaken, with a forecasted completion date of October 2022. And Queen Street, which is the development of 58 units, is at an earlier stage, and we're finalising the appointment of the principal contractor. This development is expected to be completed in Q3 2022 also. And the Tower is our 542 unit project in Manchester. We recently achieved revised planning approval and is due to enter a pre-construction service agreement with the contractor Midgard, and we expect to provide further updates in the next year regarding this project. We have had a number of challenges with our property services this year, which has been provided by an associate group of companies, One Heritage Complete. who took on the One Heritage brand following a joint venture in March 2020. This group of companies initially provided a core infrastructure of lettings, maintenance, design and cleaning, supporting our growth strategy. The two of these companies, maintenance and design, have unfortunately filed for liquidation, which we announced recently. And we've made the decision to not utilise associate companies, those with their own management and finance function, as One Heritage Complete had, but now bring in-house the core aspects to provide us greatest control. Whilst we lose the dividend income One Heritage Complete was intended to provide, we gain new fees by restructuring property services provisions internally, which all in all will provide a better service, and where we outsource elements, these will be on competitive terms. In September, we made a key hire, bringing on board a property operations director who has most recently spent 16 years at CBRE, and this role will oversee property services provisions within the group and assist with the execution of our property services strategy over the coming months. And regarding lettings, we've already made significant changes to take over a type of asset management role for our investors. This sees us utilise local agents who know the area and the market to find and manage tenants, and we take over the management on behalf of investors and landlords in-house, being a sole point of contact and handle payments. Maintenance and design will now be provided by third-party contractors and subcontractors to undertake the refurbishment work of co-living property, and the group continue to receive a profit share from completed properties, which provides a strong source of revenue into the group. And with developments completing in Q1 next year, our services for residential property will increase as we aim to provide our investors and landlords a market-leading service. We remain confident to provide quality accommodation and to build a legacy. Our vision for property services is to become a market leader in our geographical areas. I'm now going to hand over to Luke to run through the financial review.
Thank you, Jason. This section will cover the highlights in the financial year, which will start with changes to the funding and follow this with some key items on what the funds are used for. We will then look through a NAV bridge before going through the balance sheet, the income statement, and finishing on capital management in the business. Focusing on the sources of funding in the group first, on the 23rd of December, the group was admitted to the standard list of the London Stock Exchange, where we raised the gross proceeds of just over 900,000 at 10p per share, and followed this up in February with a placing in subscription that raised a further 550,000 at 30p a share. We have a loan facility with our major shareholder, which was increased from 5 million to 7.5 million. The additional 2.5 million has a lower maturity date at the 31st of December 2022, with the other 5 million of the facility not due to be repaid until the 31st of December 2024. As at the 30th of June, we had drawn down just 1.75 million of this facility. We see this as key to the risk management in the business, as well as just funding. We do aim to seek other sources of funding first, with this in reserve as a backup for periods of uncertainty. The group signed 2 construction finance arrangements towards the end of the financial year, which is part of this diversification of financing sources. This totaled 5.5 million and will cover the remaining development costs of Oscar House and Bank Street developments. At the year end, we had only just begun to draw them down. Now moving on to some of the uses of the funding. Stripping out the restructuring of the group, we incurred 5.4 million of capital expenditure across the developments, which included the acquisitions as well. The primary recipients are Oscar House, Bank Street and Lincoln House, which are all under construction. This is expected to increase significantly in the new financial year, as developments tend to follow a lazy S cash flow profile on construction expenditure, meaning most expenditure is actually to come. We did make a loss for the period of 0.8 million, which we'll go through in more detail in the income statement slide. The NAV per share ended the year at 8.4p, which will be broken down in the NAV bridge on the following page. Looking at the NAV bridge now, if we start from the left, we have the equity of the trading entity as at the 30th of June. 2020, we then undertook a debt for equity swap between One Heritage Property Development in Hong Kong, which was the 100% shareholder at the time. This totaled 2.75 mil. The group raised 1.5 mil of gross proceeds from the capital markets, as we touched upon before, with the cost of both the share issues totaling 0.4 million. This was quite high, and it did reflect the smaller size of the raises and the first being part of an initial public offering. We then generated a loss of 0.8 million, which resulted in a final net asset value of 2.7 million. We'll now go through some of the key changes in the balance sheet. We moved to a new office, which is the floor above our old office at the end of the financial year, and this generated a right of use asset, which we then added to with new fixtures and fittings. This increase in non-current assets contracted out to some extent by the write-off in relation to our associate One Heritage Complete. Unfortunately, after the year end, 2 of the subsidiaries of our associate were put into liquidation. As part of this, we took the decision to impair the value of the stake in the associate to zero and make a small provision of 24,000 against dividends we'd received from one of the liquidated entities, One Heritage Maintenance. The impairment was done as we do not believe there to be any returns from these entities in at least the short to medium term. There was no other direct financial impact to the group. Developments on the balance sheet fell from 14.7 mil to 6.8 mil. But this was mostly a consequence of the restructuring that saw the tower disposed of. The other developments are continuing to have funds spent on them, and this totaled 5.4 mil as touched upon before. The funding we provided to the co-living entities via our profit participation loans fell 0.5 mil to 0.4 mil. This figure does move, and it's dependent on the purchases and sales in the period. The issues with One Heritage Complete did cause an impact to this entity as the services from the associate were used, but it is relatively well contained. Stripping out the impact of the restructuring of the group, borrowing increased by 4.8 million. Half of this was from the 2 loan agreements with One Heritage SPC, which are due to be repaid in Q1 2022 and is a related party to the group. We signed 2 construction loan facilities that are being drawn down, along with the drawing down of the group facility. Debt levels will increase as we go through the construction phase on the 3 developments currently under construction, and then will decline on completion, where we'll realise the profit as the units are sold. An unfortunate issue with residential developments is that earnings are very lumpy and therefore sensitive to timing. The way that developments are accounted for also doesn't allow for value add to necessarily be taken into account during the build process. As mentioned earlier, the loan facility with One Heritage Property Development in Hong Kong has an outstanding balance of 1.75 mil, meaning we have an undrawn balance of 5.75 mil, which is key as the group goes into the construction phase of more developments. The group did generate a loss for the financial year of 0.8 million. But in these numbers, you can start to see where the group will generate some of the revenue in the coming years. Development management contributed 124,000, which was predominantly from the tower development management agreement. We signed a development management agreement with One Heritage North Church for the Queen Street development, which contributed 1 month of development management fees, 7,000, and then 15,000 fee on the equity raised. The new financial year will see a full contribution of fees from this site as well as a debt raising fee. Gross profit from co-living grew from 22,000 to 314,000. In the prior year, the gross profit purely related to a disposed co-living property, whereas in the current year, this was the proceeds from the profit participation loan. This is our share of profit from a disposal of 51 co-living properties, an average of 6,000 per property. As previously discussed, we have written down the associate to zero, which resulted in a £239,000 loss. The administration expenses in the business have grown significantly, and this is a consequence of the business scaling, which we did touch upon in the interims. This figure includes salaries for new employees. We averaged 4 employees over 2020 and 11 in the 2021 year end. We do have over 20 employees at the year end now. There are some professional fees and a number of costs that we do not expect to reoccur. For example, legal, taxation and consultancy fees utilised as the business built the scale for our strategic targets. The business does spend a significant amount of time monitoring capital management, and we believe it is key to maximising risk-adjusted returns. To this end, we aim to have a diversified range of potential financing sources to ensure that if one becomes unavailable because of market conditions, we have another source to meet our needs. To this end, we have a cash on the balance sheet of 0.2 million at the period end. Construction loan agreements that we have signed totaling the 5.5 million, with further agreements currently being negotiated in relation to other developments, which we will make announcements as and when they are signed. A shareholder loan facility totaling 7.5 mil, of which 5.7 mil is undrawn. And then we have the fixed loans through the One Heritage SPC, and we actually have a bridging loan on a development that we will repay when we sign a construction loan facility. We believe we are well resourced as we go through this vital period of completing our first developments. I'll now hand you back to Jason. Thanks.
Thank you, Luke. So to summarise the outlook for 2022, our strategic priorities will remain the same within the group. The success of our existing developments is paramount to the rest of the business. Looking forward to seeing completed developments from the first quarter of 2022, and this then needs to be supported by pre-sales, which are already performing well, and a strong property services provision. Internally, our focus will be on improving our team and their continuous professional development, as we had a large number join the business over the last year, which is unlikely going to be the case over the forthcoming period, as we now have internal infrastructure to take on more developments to meet our target of 400 units by 2024, with a clearer pipeline later next year. An area I've been particularly pleased in is the progress we've made with ESG, and will be an area we'll certainly be adding to in further detail over the coming months. Particular highlights include charity work, establishing a partnership with a homelessness charity in Manchester, and internal fundraising initiatives where our employees have raised over £4,000 for various charities. These initiatives are facilitated by our employees, who we support with up to 2 days paid leave per year towards charitable commitments. Environmentally, a review of our developments is ongoing, and I've been pleased to see initiatives to switch to more environmentally friendly materials and energy efficient products. And from a governance perspective, we adhere to QCA, and with updates due to be published on our website over the coming weeks. A major highlight includes the changes we've made to future-proof our developments by becoming EWS1 compliant, which is only currently a statutory requirement over 18 metres, but we've switched to non-combustible products now. This change provides security for our investors and ensure we're exceeding the safety guidelines. I'm expecting to announce further changes and improvements to ESG later next year. In conclusion, the last 18 months has been a challenging period against the backdrop of COVID, multiple national lockdowns and industry cost pressures, which we've adapted well to. In 2022, 3 developments will finish. We expect most, if not all, of our developments to secure pre-sales prior to completion, and income generation from development management and property services continues to grow. And thank you for listening, and we'll now take some time to answer any questions.
Jason, Luke, thank you very much indeed for updating investors this afternoon. Ladies and gentlemen, please do continue to submit your questions using the Q&A tab situated on the right-hand corner of the screen. But just while the company take a few moments to review the investor questions submitted during today's meeting, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your Investor Meet Company dashboard, and we will send you an email when it's ready for your review. Finally, I'd also like to remind you that your feedback is important to the company, and immediately after the presentation's ended, we'll redirect you for the opportunity to provide your feedback in order that the company can really better understand your views and expectations. It's only a very short period of me waffling on, but hopefully that's giving you a couple of moments to look at the questions that have been submitted. So we did receive a couple of questions ahead of today's event, along with those questions that you can see in front of you now. So thank you to those investors that have taken time to submit questions. And perhaps, Jason, Luke, I can hand back to you. And if I could ask you to read out the questions and give a response, that'd be most grateful.
Thank you, Mark. So, yeah, as you mentioned, we had a pre-submitted question which asks about the different capital requirements of different segments and about KPIs we'll report on in the future. So, as we complete the developments, we'll release a full range of metrics for investors to appraise the performance. That they'll all be familiar with, the normal ones, return on equity and things like that, and profit on cost, a lot of development and property specific ones. We want to be transparent on how the capital in the business is allocated and what returns we'll get from the different segments of activities. You are right, some activities are more capital intensive than others, which can make comparisons slightly difficult, and communication will be key from our point of view here, so that investors will understand why we're making the decisions on capital allocation we are and what the impact on returns this is going to have. Okay, I think so next question. So what are your views on the residential market, and do you expect values to decrease? Thank you, Grace. Residential property markets have boomed across the development world for a sustained period now. Really, it's due to decline in interest rates, which have boosted asset prices more generally, with particularly strong growth in the post-COVID period as a result of excess savings accumulated being directed towards property. Both these factors are unlikely to, I suppose, support prices and may even be a drag going forward. Focusing more locally, though, we do believe that the Northwest will continue to see outperformance over the other regions. It's got great infrastructure, cultural heritage, and an education system that makes the area really attractive. It'll also be more attractive relative to London as well. It's got closer proximity to nature, lower relative prices, short commute time, and these will continue to be really attractive. And we think these factors will continue to drive better performance.
Yeah, just to add to that, Luke, what we initially saw is an increase in demand for different types of property over the last 12 months. Detached property, for instance, has exceeded the performance of others, which was as a result of the lockdown and demand for outside space, and also a larger deposit during the stamp duty holiday, which pushed people up a price bracket. What we're now seeing is demand changing again. People are returning to city centres, and there seems to be a shortage of rental accommodation. Recent reports suggested less than 500 flats available for renting in Manchester. And this demand will likely affect the prices of flats and self-contained apartments, with their values driven by rental performance. And it's this area of the market we expect to see positive performance over the next 12 months. Got here, do you expect construction price increases to reduce your profit? There's been significant inflation in construction materials over the last 12 months, caused by a number of factors, COVID and Brexit in particular. We are expecting some stabilisation over the coming months and into early 2020, but expect a level of cost increase to remain, especially if energy prices remain high as they are at the moment. We do have the benefit of 3 fixed price build contracts, which provides us with some protection, albeit pushing the risk onto contractors. With the property market performing well, any construction price increases that remain, we're hopeful will be offset by value increases. Another question here from Keith: what opportunities are there to win development contracts from entities not connected to your parent company? So our priority is internal projects within the group, and what we already have under a development management contract. And we see future contracts or development management agreements as an opportunity to complement what we have in the business and provide the ability to scale and generate income without the development risk. Development management is an opportunity to grow the company, and as we have success with our developments, grow our brand and profile and really showcase the ability of our team, I would expect future opportunities and interest locally, especially away from the parent company. Wouldn't be able to provide any forecast, but any opportunities will be carefully considered. Another question from Keith: what is the potential for income from letting services to tenants now these services have been taken in-house? So I think there's a good opportunity to grow property services. We now have 250 co-living rooms, 138 apartments under construction due to be completed next year, and the developments under a development management contract. The performance of One Heritage Complete has meant a change of strategy to move away from providing property services through an associated company to in-house. But there are elements we will need to continue to outsource. For example, lettings, what we're now doing is taking on more of an asset management role, whereby investors deal with us. We have our own CRM system, we'll make payments, we'll issue statements, and then we'll outsource elements to local agents to find tenants and deal with the day-to-day management. Wouldn't be viable for us to set up satellite offices and recruit to fill properties, but what we can do is establish core processes and an infrastructure internally to communicate and provide a strong service to our investors. And we've added to the team, bringing on board a property operations director of 16 years experience, but we want to be careful we don't run before we can walk with this. Fees will be generated from a number of services, including a management fee from rental income, service charge costs, amongst other potential revenue sources. But the focus is on getting the right service and as the volume of property increase within the group, making this part of the business as efficient as possible. And then we've got a final question from Darren. I think it's kind of two questions. I'll probably answer the first part of this, and I think the second part's you, Luke. So what is the biggest obstacle to the pace of development? And on the subject, in terms of construction finance, is the scope to move to larger umbrella agreements where you don't need to negotiate on a property by property basis. So in terms of obstacles, I talked about the planning delays during the presentation. It's the biggest obstacle at the moment. It seems to be one of the main areas of the industry that struggled to adapt to COVID. We're seeing a number of extensions, and our peers and colleagues elsewhere are receiving the same type of frustrations. In terms of construction itself, biggest risk to delays, COVID as one, supply chain issues. We've just seen a shortage of petrol, for instance. But the fact we are converting existing buildings, the uniqueness of the development and the product is probably the greatest risk. We did find a number of challenges on our Bank Street developments once you start ripping out the development. It's a former magistrate court, for instance. So that's a challenge. And we move towards winter, so fingers crossed we don't have a bad winter, but we're close to making the buildings wind and watertight. So already kind of planning and getting ahead of any kind of bad weather.
Thanks, Jason. Yeah, on the second point, yeah, this is actually where we want to get to. I think it is one of the optimal sources of finance. If you've got a facility agreement that covers, well, it's at the higher group level, and it can be used to fund a number of developments. The reality is, because of the trading history the group's got, it's not long. We have to make do with construction finance on more of a property by property basis, and it's something, once we've got the first set of developments finished, we'd expect to be able to negotiate these type of agreements. So it's something we are looking to do. It's just the realities of the company at the moment and the stage of development. Thank you.
That's great, Luke. Jason, I think you've taken every question that's been submitted by investors. So thank you for doing so, and thank you to investors once again for submitting questions. If any further questions do come in, we will obviously make those available to the company. Guys, I know investor feedback is important to you, and we will shortly redirect investors to give you their thoughts and expectations. But perhaps before doing so, Jason, I could just ask you for a few closing comments to wrap up with.
Yeah, sure. So, yeah, thank you for attending our first annual results presentation this afternoon. Hope it's provided further insight into the business and expectations over the forthcoming period. We're looking forward to 2022 with 3 development projects due to finish in Q1. Pre-sales of our properties continue to be strong, and the income generated from development management and property services continues to grow. We're pleased with the progress we've made today. We have a fantastic team of people in the business to allow us to execute our strategy. And further updates will be provided over the coming months as both sales and construction of our developments continue. And appreciate everyone's time listening today, and have a good evening.
Thank you.
Jason, Luke, thank you once again for updating investors this afternoon. Could I please ask investors not to close this session, as we'll now automatically redirect you for the opportunity to provide your feedback in order that the management team can really better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of One Heritage Group PLC, we'd like to thank you for attending today's presentation. That now concludes today's session, and good afternoon to you all.